Good morning, everyone. So I'm talking today about Carly Car Subscription. We'll talk first of all about the background and positioning of the business and some of the strategy, and then we'll move into the Q2 results. We've recently announced record January results as well, so I'll cover those as well. So Carly is a car subscription company, and we're an early mover in both the car subscription and electric vehicle markets. We're quite privileged to have very large shareholders on our register, which are big players in the automotive industry, including SG Fleet, Turners Automotive, and RACV. And we also count Hyundai as one of our strategic partners. We're the only ASX listed company that is focusing on car subscription and electric vehicles. So a car subscription, the best way to describe it, it's longer than a rental and it's shorter than a lease. We provide vehicles to individuals and businesses who would normally buy or lease or finance a vehicle, but they need them for a shorter period of time. The research that we've done in Australia regarding car subscription shows that 38% of Australians are interested in subscribing to a car. And as you go down through the younger age groups to millennials and Gen Z, that level of interest increases. So that says to us that as we move into the future, more and more individuals will be interested in our business. We're operating in 4 key segments. Consumer, where we started. We've more recently moved into the business market. We're ramping up in the electric vehicle market, and we're also providing other opportunities through software licensing as well, which is diversifying our income streams and leveraging our existing technology. We also operate on a direct and partnership model with our vehicle fleet. Our direct fleet is the fleet that we own ourselves and we monetize directly. Under our partnership model, we monetize vehicles that are owned by automotive dealers, manufacturers, or fleet management companies. And I'll explain a little bit later the advantages of both of those models. We've been seeing really good growth. In the latest quarterly results, we saw 80% increase in subscription revenue year on year, and that was on the back of a 41% increase in total fleet size. So what is a car subscription? It's a fast, flexible, and low-risk way for individuals and businesses to access cars. It's a simple monthly subscription fee. It includes all the major costs of registration, insurance, maintenance, and roadside assistance. There are no break fees, no upfront deposits. It's a minimum 30-day term, and you can cancel with 30 days notice. So you can see from this, it's very different to rental, and it's very different from car ownership. And most importantly, it's not a long-term financial commitment or debt. So in times of cost of living increases, a lot of people are looking at car subscription because they don't want to take long-term debt in the current economic circumstances. So this chart illustrates where we fit within the market. You can see car share is 1 hour to 1 day, very expensive. Car rental averages around the 1 to 14 days mark and is still quite expensive. Car subscription, our average subscription period is 5.1 months. So very different to that rental type proposition and a fair bit shorter than the outright purchase or longer term finance options as well. So we aim to be a major player in a number of key segments. In number 1 car subscription company, obviously, number 1 in the consumer market, number 1 in the corporate and government market, number 1 in electric vehicle subscription, and the number 1 choice for auto OEMs and dealers. So let's look at where we are right now. We're already well established on the East Coast. We're an early entrant into the EV market, and we have access to asset finance to grow our vehicle fleet, and we have strong strategic partners. In the consumer market, we have a very strong online presence and a low cost of acquisition with expanding referral partnerships. And an advantage for us is our long retention period for customers. In the government market, we have our own direct corporate sales team that we've just established. And we also partner with SG Fleet, who refers their customers from business, government, and not-for-profit when they require vehicles for a shorter term than a typical lease term. We have a strategic relationship with Hyundai, who provide us with a number of asset-light vehicles, and especially electric vehicles. And we also have a relationship with ChargeBox, and through that relationship, we provide free charging packs to our EV subscription customers. We also power the subscription service for Turners Automotive in New Zealand. Turners is the biggest seller of cars in New Zealand, and they've seen the opportunity to not only sell cars, but also offer subscription vehicles to their customers. We also monetize vehicles on behalf of Hyundai. So our most recent progress in all of these segments, 41% increase in fleet size, as we saw before, and on top of that, an 80% increase in subscription revenue. We now have multiple consumer referral channels and also further referrals coming through from SG Fleet in the consumer side, and we've expanded our social media presence. We've made key hires for our corporate sales team, and we've also established a sponsorship deal with Fleet Auto News, which is the major publication going to fleet managers in Australia. And also we've expanded our corporate presence with SG Fleet referrals as well. We've just recently started purchasing electric vehicles. That doesn't mean that we're a late mover into the electric vehicle market. We had a number of asset-light vehicles from Hyundai for over 18 months now. But we've now taken the decision to purchase our own electric vehicles because we see the market as now matured enough that it's the right time for us to enter the market. And we also have the Carly Now product, which allows automotive dealers to sign up subscribers in the dealership and access all of our back-end services, technology, verification services, and also insurance. So we see a massive opportunity in the immediate future for electric vehicle subscriptions on a try before you buy basis. We're helping our customers to understand the transition to EVs by giving them the opportunity to trial an EV before they make the expensive and long-term decision to buy an electric vehicle. We also see that in the future, subscription will be a normal thing for people to do for EVs for longer periods of time. So looking at our December quarter results, we see that 41% increase in fleet size up to 377 vehicles. Subscription revenue grew 80% to $843,000 in the quarter, and cash receipts grew to $1.21 million, up 33%. So this graph shows our growth in subscription revenue, and you'll see in September 22, there's a big jump in subscription revenue. The reason for that is that we started to focus on asset-heavy vehicles. They are the vehicles that we own versus asset-light. Typically, asset-light during the COVID period, those vehicles were in short supply because there were supply restrictions for vehicles right across the board. So we took the decision to secure our own asset finance and build our own fleet. And this is where you've seen the big increases in subscription revenue. Our asset-heavy fleet represents around 69% of our total fleet at the moment. So further looking into these results, our annualized revenue run rate increased to $3.7 million, and that's a 19% increase versus just the previous September quarter. We unlocked access to another $6 million of asset finance, and we immediately placed orders for 109 vehicles valued at over $4 million. We made key management hires from adjacent competitors. So we've brought in senior managers from both the rental industry and also the leasing industry. Because we sit between both of those industries in terms of the time period of our product, we see that we need to learn from those adjacent competitors. They're looking at our business. We need to look at their business and understand where the opportunities are for subscription. We also completed a $2.85 million convertible note to support our further business expansion. And to clarify here, we use asset finance to purchase vehicles, and the convertible note is for our business expansion, not for the purchase of vehicles. We also placed our first orders for electric vehicles. And the reason that we've taken a while to purchase our own vehicles is we wanted some of the early issues of resale value to play out through the market. And it's recently been seen that Hertz was one of the companies, especially in the US. They made the news by selling over a third of their electric vehicle fleet because of the reduction in resale value compared to the purchase prices. We saw that that was going to happen. We saw that the purchase price for electric vehicles was coming down. So we waited until we could find vehicles at reasonable prices. We've recently decided to purchase the MG4 electric vehicle. This is a vehicle that we can purchase for around $40,000. It's the car sales car of the year. It's 5-star ANCAP rated, so it's highly in demand by fleets and also individuals as well. We resisted the temptation to go for the amazing press release and saying we're buying lots of Teslas. We knew that was going to end in tears for many companies, and we're glad that we've held our ground on that strategy. So we've also released a January update because we achieved some record results. So this is comparing to December, just the previous month. We saw a 20% increase in cash receipts and a 12% increase in subscribers, and they are the largest increases we've ever seen on a monthly basis. We saw an 6% increase in fleet size to 400 vehicles, and 18 new vehicles were delivered in January, including the electric vehicles. And this growth was driven by consumer subscriptions, business subscriptions, electric vehicle subscriptions, and also growth in our asset-light fleet of vehicles being provided by OEMs and dealers. So looking a little bit deeper into our fleet, we had 377 vehicles at the end of December. That increased to 400 vehicles by the end of January. Our raw fleet utilization, which is measured at the end of the month, was 80% in December, and that shot right up to 86% at the end of January. So we've started the 2024 very strongly. Asset-heavy vehicles now make up 69% of our fleet at the 31st of January. We will continue to monitor the supply situation of vehicles. In certain supply circumstances, when vehicles are being discounted and there's an excess supply, we will favour asset-light vehicles. At the moment, we're favouring asset-heavy because the supply restrictions, even though they've used, it's quicker for us to secure cars through an asset-heavy type arrangement. But as you've seen, we're also seeing increases in our asset-light fleet as well. We still have orders for 91 vehicles valued at over $3.3 million, and we have another $2 million yet to deploy from our asset finance facility. And we've had 44 electric vehicles ordered, and 12 of those were delivered to the 31st of January. And those vehicles are being delivered because we're preparing for another electric vehicle product launch in March of this year. So Carly's competitive advantage is that we're not a newcomer to this market. Even though we only launched Carly in 2019, we pivoted from an adjacent company operating in the car rental industry. We saw a much bigger opportunity in car subscription, that we could be a bigger fish in a, at the time, smaller pond, but what we expect to be a very large market. We have strong strategic relationships with SG Fleet, Hyundai, Turners Automotive, and other organisations. We're an online business, but selling a physical product. So we have the benefits of online customer acquisition. We're also a mass market proposition that suits both business and consumer. Any person at any time of their life could be a suitable customer for car subscription. We're aligned with the growth of the electric vehicle market. And importantly, our product is not a long-term financial commitment or debt. So we don't fear any industry regulation or any issues related to finance companies or banks. We actually see that we are clear of those issues and could benefit from many other restrictions that are placed on those other parts of the market. We receive direct and partnership revenue, direct revenue from the owned vehicles that we offer to subscribers, and the partnership revenue from our software licensing and where we monetize vehicles on behalf of other vehicle owners. We also see ourselves as an indispensable partner to large automotive players. Many of the OEMs and dealers will be entering the subscription market, but they know that they can't do it on their own. They don't have the expertise, the technology, the experience of verifying customers, managing fleets in the field. So this is where companies like Hyundai and other automotive groups partner with us so that we can jointly provide their vehicles to the market. We have our owned fleet, and that is supported by our asset-light fleet. So currently owned fleet is 69%. We think that our fleet typically will be either 60-40, maybe moving to 40-60, depending upon supply conditions, but we're totally in control of those decisions. We also have our own peer pass verification platform, which is supported by AI and machine learning, which is our secret sauce in verifying customers online very quickly, efficiently, and with high level of certainty, which means that we put very good quality customers in our cars and we turn away the poor quality customers. We also have an ATO product ruling, which defines the FBT treatment for car subscription and also the tax deductibility as well. So we are a well-recognised option for people seeking vehicles. So in terms of the investment proposition for Carly, we're operating in a market that is expected to be $100 billion globally by 2032. We're also operating in the Australian market, and we're 100% focused on car subscription. There are other players in the market, but very, very few of them are actually 100% focused on car subscription. Their car subscription play is an offshoot of an existing business. And we see that that divided focus provides opportunities for Carly. We have a proven business model. We worked very hard through COVID, through very challenging times where the government was telling people to stay at home, not to drive around. When car supply was challenged, we actually grew quite substantially during that period and used that opportunity to really hone our model. A major advantage for us is that we retain our customers for 5 months on average. We're securing the pathway to profitability. We have a consistent track record of delivering large revenue increases, but we've also got a very tight control on costs as well. And we have big opportunities in the consumer, business, and electric vehicle markets. We're also scaling directly and via strategic partnerships. We know that we can't access all of the opportunities in the market on our own. And in many cases, it is good for us to partner with other bigger players, access their customer bases. And we are important to those larger players because we provide a product that they can't provide themselves. And the $13.2 million of asset finance is really helping us to grow our vehicle fleet. So thank you very much for listening this morning. Now, happy to take any questions.
Thanks, Chris. And yeah, I'll just once again say the latest research report from RaaS on Carly I've uploaded into the chat for anybody who wants to download it here while we're tackling the questions. Chris, just one thing on the you talked about, the 5 months. I'm gonna say now, just in the consumer segment from here, it might be different in the business and government sector. But has that 5 months been pretty stable since you started, or has it been trending upwards as the Carly brand and more so the kind of subscription idea, product, service, has started to gain traction in the market? Just maybe give us a sense of how that 5 month retention of customers has changed through time in the last 18 months maybe.
It's always been around that 5 months mark. We were working hard to push it up, but also sometimes the customers, having a car for less than 5 months makes sense for them. So to give an example, we provided vehicles for the Sydney Blue Sox baseball team. And a lot of these players come in from America or Japan to play for the season. Now, they need vehicles to go to training, to go to the games, to live their daily lives. But it makes no sense to buy or lease those vehicles. They also don't know how long they'll have the vehicles because they don't know whether they'll get into the finals. So subscription is a perfect opportunity for them. I think the season ran for about 3 months. Unfortunately, that team didn't get into the finals. They gave us 30 days notice to hand the cars back, and they handed them back after about 4 months. So that's still very good business. It's very good corporate revenue. It's also multiple vehicles out to the same customer. So we're not going to turn away from customers who have that shorter period of time. We still do make very good margin from those opportunities. And also, sometimes it might be that an individual might need a car for just 30 days or just 40 days. So we're not trying to shy away from the shorter period subscriptions, but we are trying to focus, especially in the corporate market, on where we do have use cases for customers who will take vehicles for longer periods of time. And one area that we've identified is in the work visa area. Employees who are on work visas sometimes find it difficult to secure finance for a vehicle, and they are more likely to take a subscription for a longer period of time. So that's a current focus for us at the moment.
Okay. And then as you've kind of ramped up the own fleet as you talked about, have you been able to, get better pricing now that you're kind of buying more vehicles on a like regular basis, whether that's, buying through, I don't know if it works through, Turner's NSG fleet. How have you, as you've kind of scaled up that, been able to, get maybe keener pricing and improve your margins on the buying side of these vehicles at the asset owned end?
Absolutely. And there are two main factors in play there. One, the competition is heating up in the market and supply is improving. So the dealers are discounting. We also do have fleet discounts for all the major automotive manufacturers. And the manufacturers like dealing with us because compared to selling to, say, a rental company, that rental company may turn those vehicles over in 3 or 6 months and dump them back on the market and drive down the resale values. We've never sold a car. We started purchasing vehicles in 2021. We hold our vehicles for 3, 4, or possibly longer because what we find is that our customers drive very few kilometers. It's an average of 1,000 or 1,100 kilometers per month, which means that there's very little wear and tear on our vehicles, and we can extend out the life of those vehicles and derive the maximum amount of return on investment from those vehicles. So a very different proposition compared to that rental market, and certainly we are favoured by the manufacturers.
And one thing I know from listening to a lot of businesses on here over time, when you're dealing with corporates and particularly maybe the larger corporates, they do like somebody that's got a national presence. So, Carly moving into the Perth market, I'm not sure if you're in Adelaide when you talk about the East Coast market, but getting that maybe national footprint so that corporates can have the car subscription and the Carly subscription option available in kind of most of the state capitals. Is that also a future plan or feedback you're getting from customers you're engaging with on the corporate side?
The advantage of Carly being an online proposition is that we're a virtual business. We don't necessarily need bricks and mortar in a certain location to be operational in that area. We have our own facilities in Sydney, Melbourne, and Brisbane. When we work with dealers, each of those dealers becomes a handover location and a storage location for us. Just this afternoon, I've got a meeting with a big corporate who's looking at securing vehicles in a state that we're not currently operating in, but we could be operational in that state within about a week. So we don't see that as a major impediment. What we seek to do is secure momentum in a certain region. Once we have that momentum, then we'll put our own resources into that area if we need to. For example, we have our own people in Sydney and Melbourne, but in Brisbane, we outsource our storage and handover services to another party, and it's on a pay-per-use basis. So we operate on a very cost-effective basis, but as soon as we see a suitable level of volume, that's when we put more investment into those areas so that we can increase the demand yet again.
And you know that there's other players trying to come into the market or have entered the market. In terms of pricing dynamics, maybe just touch on that, where the current market is. Is it we've seen inflation coming back down. Just overall, has Carly been kind of able to push up prices as we enter this 2024 year, or as you've kind of been the mainstay player, using a bit of that market dominance to kind of charge a slight premium maybe on what the overall market is doing?
We have been increasing prices all through 2023, and we've actually done some more price increases in January. We don't think that the market price for car subscription has yet been established. So we still think there's more opportunity to increase prices. The feedback that we're seeing from customers is that rental is very expensive, but also leasing is more cost effective, or purchasing is more cost effective, but you have to purchase or lease that vehicle for 2, 3, or 4 years. So the break costs in that situation can be very high. So we think that there is opportunity to push up our prices as we gain market awareness. We think that we can push those prices up, but at the moment we are very good value for money.
Okay. And in terms of the corporate end that you're going to start pushing in with SG Fleets, is that looking at enterprise level stuff, like government departments, where you're talking 50, 60 cars at a time, or is the focus more on those smaller ones where they're looking for 5 to 10 cars, but maybe on a rolling basis that's going around the company over a 12-month period, and then they reassess, so actually we need 10 to 15 the following year. In terms of where you're targeting within the corporate space, is it the really big enterprise stuff, ASX 200 names, for example, or is it kind of your more mid-level SME kind of customer?
It's all of the above. The use case is pretty much the same, regardless of the type of business. One that we're discussing at the moment has 6,000 employees in Australia and more globally. Then we could be talking to an organisation that might have 4 employees. So for us, it doesn't really make much difference. It's the same level of service that's provided. It's similar vehicles that are required. So we're not cutting ourselves off to any of those opportunities at the moment. We have access to the asset finance, and we know that we can quickly secure vehicles as well. So volume is not a concern to us, and we've got the systems in place to rapidly close those deals and get those subscriptions happening. So we're taking a fairly broad approach with that. With our own business development efforts, we're focusing on more the small to medium organisations, because we can get quicker decisions within those entities. But in terms of referral, we are looking at every referral that comes in and really not turning any of them away.
Okay. Chris, we're bang on time, so I think we'll leave it there. Thank you very much for coming in and giving us an update on all things Carly. And yeah, we'll keep an eye out on updates through 2024.